Most people think investing in stocks is how you build wealth. But if you're starting in your 40s, then that strategy alone is often not enough. But there's this investment order that if you follow can 2.5 times your lifetime wealth and close the gap between where you are right now and where you want to be. But to understand how that works, you first need to understand the problem. Take a look at this table. The typical life course follows a 2-to-1 work-leisure ratio. So you work from say 25 to 65, so that's 40 years. And then from 65 to 85, you take it easy. That's 20 years. So ultimately what this means is that you need to work 2 years to pay for every 1 year in retirement that you're not working. But more importantly than that, what it means is that at best you have 40 years to build wealth, which seems like a lot of time. But if you follow traditional finance advice, you need every second of it. In your 20s and your 30s, you weren't making relatively that much, and so you weren't able to invest that much. And so the investments that you were making were smaller, and then they needed longer time to compound. But that's okay because you had the time. If you start at 20 years, you invest $300 a month at 10% for 40 years, then you end up with 1 million, which is typically enough for most people to retire reasonably okay. But the problem starts here when the ratio changes from 2-to-1 to 1-to-1, which is exactly what happens when you start taking your finances seriously only in your 40s. And by the way, if you've spent your 20s and 30s doing other things, then that's perfectly okay. If you spent that time, figuring out your career, experimenting, hustling, traveling, whatever it's been, there's nothing to regret. But now that you're here, you have to accept that there has been a trade-off. And that trade-off is that now your ratio is 1-to-1. You have 20 years to pay for another 20 years. When everyone else had 2 years to pay for 1 year in retirement, you only have 1. And as you're just taking it seriously, if you only follow traditional finance advice, you'll find it's not enough. And this is what every 40-something-year-old realizes when they start trying. And then they try to fix it in 2 different ways. They first try to increase their capacity to invest. They cut back and try to save more than they already do. This definitely helps. If you save money, you invest more and your investments grow bigger, faster. But it's also often very difficult to maintain. In your 40s, you have bigger responsibilities, more people depend on you. So yeah, one might be earning more than you ever have before, but you've never had as many demands on you either. The second is they chase higher yields. They get seduced by crypto, startups, and high growth stocks, investments that promise much higher returns. Again, this makes sense to some degree. Higher returns will get you where you want to be much faster. But of course, the problem is they come with much more risk. The likelihood is they won't pan out the way you hope. And in the end, instead of catching up, you'll actually fall behind even further. Well, the truth is that when you start building wealth later in life, then compounding isn't enough. You invest $1 today, and over time, 10% for 40 years, you'll get $46 back. That's time leverage, right? It's compounding. For every input, time produces a disproportionate output. But when you're short on time, then you get smaller results. And so you need other forms of leverage to catch up. It's like trying to win the same bike race with the same bike in half the time. It's just not possible. But if you change vehicles to a motorbike or a car, then it is possible. In fact, it's likely. And it's very realistic for most people in their 40s to change vehicles. So let me explain what I mean by contrasting 2 realistic examples. So the standard approach is to save part of your income every single month and put it into a high-performing ETF. One of the highest performing ETFs these days will link to the S&P 500. You'll typically get maybe around 10% return. So let's say you make $70,000 a year after tax and you save 10%. So that's $7,000. So $7,000 at 10% for 25 years. That's $688,000. Now it's not bad, but is it enough? So applying the 4% rule here, we can determine that, right? So the 4% rule is basically just a retirement guideline. So it tells you that you should have, in your portfolio, you should have 25 times what retirement income you need. And so at 688,000 divided by 25, that means you'd need to live off 27,500 a year. Yeah, that's almost 2.5 times less than what you would live off right now. It's not enough. So this is a clear sign that you need to change vehicles, right? The vehicles of stocks is just too slow. And so the new vehicle you need is you, right? You got to invest in yourself first. And the reason why this works out is because skills are just as valuable investments and assets as stocks are, right? In some cases, even more. Like when you start out, the return on skills is much higher than the return on stocks. Like a skill or a qualification can bump your salary $10,000 a year, no matter how much you're making. But to make $10,000 from your portfolio, you would need $100,000 growing at 10%. Most people don't start with portfolios that big. And at the end of the day, stocks carry a lot more risk than skills do, right? In theory, stocks can go to zero and skills really don't. Even if you change industry or companies, you can redeploy them in a different job, or at a different company. The real value here comes from combining the two in the right order. And so that's really what wealthy people tend to do. They invest in their skills to create capital, and then they invest in stocks to multiply it. So a typical pay raise after a high value training or a professional qualification in your industry typically returns around 15%. And now when you look at a lot of these courses and a lot of these qualifications, they generally cost around a few thousand. But let's say, for argument's sake, that it costs you 1 year of savings, so $7,000, right? And we also acknowledge that if you put the first $7,000 you have into yourself and invest in yourself and not in stocks, then you lose 1 year of investing. You can invest now for 24 years, not 25 years. And so here's how this breaks down. If you get a 15% raise, now that means that after tax, you're now making $80,000 a year. And if you continue to live off $63,000, which will be inflation adjusted with other pay raises that you'll get, right? This pay raise is specifically from doing a course, doing a qualification. Then that means you have $17,000 to invest. You've effectively more than doubled your investment capital. For every $1 you had to invest, now you have $2.50 to invest. And so what difference does this make? Well, let's see. So that's now $17,000 a year at 10% for 24 years. And that gets you to 1.5 million. That's definitely a big difference. So now again, let's apply the 4% rule here. So it would be 1.5 million divided by 25, and that gets you to $60,000 a year. That's very close to your current living standard. Much, much closer than if you just invested in stocks. You've changed vehicles, and now so you can win the race, even though you just start halfway through. But you don't have to be wealthy to do this. In fact, pretty much anyone can do it. But you do need to pick the right skill, because picking the right skill is like picking the right vehicle. Some will get you there and some won't, and most people invest in the wrong skills, in the ones that won't get you there. Let's compare for a second. Free online industry courses versus specific professional certifications. General executive MBAs versus PMP certifications. Mainstream networking groups versus niche technical groups. The reality is, just like stocks, some skills are overvalued and some are undervalued. An executive MBA can cost you 10 times more than a professional qualification will cost you, and often return you less for it. Yet people still do it. They overinvest in what underperforms. But the good news here is that picking high value skills is significantly easier than picking high value stocks. When you buy a stock, you're making a prediction about the future, right? You're looking at management and economics and all sorts of data. So many variables you just don't control. Even professionals struggle with this. For skills, the process is much simpler and much more accurate. You can see what the market rewards. You can see what employers are doing to get paid more. And then you have a lot of control, right? You can put in more work, you can study harder, you can apply more experience. And then the more you do of all of those things, the more valuable this investment is. So what this comes down to is that if you want to catch up, then you need to invest in a high value skill that will double your investment capital, which will double your wealth over the exact same time frame. And the only thing you need to do to get started is to carry out this cost value matrix. Start by making an exhaustive list of the skills and certifications applicable to your industry and your job. Then score each one on 2 dimensions, cost and value. Cost includes how much you have to pay to acquire the skill or certification, but also time and effort. How long and hard is it to acquire? Value then is the opposite side of that equation, right? Ask yourself how much the skill increases earning potential. These are very easy numbers to find. You can also go a little further and determine if the demand for the skill is growing or shrinking. Once you've scored both dimensions, place each skill in one of the 4 categories. High value, low cost skills are the best opportunities here. These are skills that don't take years to master but can significantly increase your income. They should be your first priority. High value, high cost skills can be excellent investments as well, but they require a longer time frame. The payoff may be substantial, but also is the commitment. You should invest in these second if you can, because it increases the probabilities that these big pay raises aren't just one-offs. And then low value, low cost skills are generally useful, but unlikely to transform your financial future. And low value, high cost skills are usually the ones to avoid. These consume significant time and energy without providing enough economic return to justify the investment. Remember, you're not trying to find the perfect skill here. You're trying to identify the skills with the highest return on investment. And then invest in increasing your income, and then use that extra income as cash flow to invest into the stock market. This will 2.5 times your wealth and get you to your goals much faster.